Well, good morning and welcome to a FS Club Zien Long Finance webinar. And the subject today is the Global Green Finance Index. And today, this morning, we are at the launch of the 9th index that we've had in this series. You'll know me, I'm Michael Mainelli. I'm one of the directors of Zien, and I'm only able, as is my team, to run such webinars and do such research thanks to the tolerance and generosity of our sponsors, many of whom are listed here. A group of people around the world interested in technology, economics, and finance, and yes, indeed, also the issues to do with green, as well as our two other indices, financial centers and smart centers, so both technology and finance. Now, for those of you who've been to ours before, this will follow a fairly similar agenda. My job is to get out of the way as quickly as possible, let you hear from our expert, Mike Wardle, who is Director of Indices at Zien and has compiled the index. Mike will be speaking for approximately 15 minutes, and then I have a few commentary points I would like to make, in particular about an interesting supplement that we have in this edition. If I could raise three things. Firstly, yes, the slides are available. In fact, they're online already and posted in the chat room, as well as, and I might encourage you, read the full report. The slides are only a summary of a fairly extensive report of some 70+ pages. The second thing I'd like to say is, yes, this is being recorded and it will be posted hopefully tomorrow, Friday, and feel free to share with friends and colleagues. In fact, encourage them to join FS Club. As you know, it provides a wealth of free information and knowledge. Thirdly, we are going to have a 15-minute Q&A, which Mike and I would really appreciate if you feed your comments, questions, observations into the chat bar down here in the GoToWebinar question facility. I'll feed them in to a conversation with Mike and with you, the audience. All of your comments and questions will be recorded with your email, and so if we have not got enough time to get to you during this morning, we will get to you offline afterwards. May I say we really do appreciate comments and questions, because we are trying to produce this index in aid, if I can say it, of the planet, and so anything you do that helps us to improve it helps the planet. There you go. What a way to start. So if I could, I'm now going to hand over to Mike Wardle, who's going to talk us through the results of Global Green Finance Index number 9. Mike, the floor is yours.
Well, thank you very much, Michael, and good morning to you if you're in Europe, good evening if you're in Asia, and whatever time it is in other parts of the world. So to talk about the Global Green Finance Index 9, the idea of the index is to track the development of green finance offerings in financial centers across the world. When we started running the index in 2018, we were tracking 47 centers. We're now including 81 centers in the index, showing, I think, a growth in interest in green finance across financial systems, but also the growth of financial center offerings. And the GGFI is designed to encourage financial centers to enhance the range and depth of their green finance offerings, to showcase best practice, and to foster a race to the top so that financial centers get better at their green finance offering. A couple of definitions. Some people ask us, well, how do you define a financial center? It's quite a difficult question, but one of the definitions that we use is cities with an intense concentration of financial activity involving the interlocking sense of financial sectors and transactions. And green finance refers to any financial instrument or financial services activity which results in positive change for the environment and society. So effectively that it's some sort of instrument that contributes to the reduction of the emission of greenhouse gases. The GGFI is a factor assessment index. That means we combine two different types of data into one. The first set of data is survey data taken from a questionnaire which runs 24/7 online. And secondly, a set of instrumental factors. These are quantitative data measures which track a range of different factors in financial centers across the world. And we combine those using machine learning algorithm, which looks for the relationships between the assessments and the data factors and combines them into the index rating. So who gets involved in the GGFI? We track the respondents to the GGFI survey, and you'll see that we get a wide range in terms of the sectors in financial services, in terms of the people who complete the GGFI survey. In terms of respondents by region, Asia Pacific and Western Europe make the largest groups of respondents who get involved in the GGFI survey, but we do have respondents who come from all parts of the world. So some headlines for GGFI 9. First, London and Amsterdam maintained their first and second positions, both improving their rating by more than 10 points. And that's quite significant, I think, that both of them are seen as leaders in the field. London may well have benefited from UK government action on green finance. Last year we issued the first UK sovereign green bond, and its position as host of COP26, both in Glasgow last year and during the follow-up period we're now in. Western European centres take 7 of the top 10 places, with US centres taking the other 3 places. And then there's Asia Pacific centres then feature in the top 20, with Sydney moving into a leading position in the region. Interestingly, in this edition, New York moved for the first time into the top 10, taking 5th place in the index. And the margins separating centres at the top of the index have broadened very slightly in GGFI 9. Among the top 10 centres, the spread of ratings is 45 out of 1,000, compared to 25 out of 1,000 in GGFI 8, but that is still a close margin, given the range we're talking about. Looking at the top 20 centres, just to recap, but interestingly, the top spot in the US is not New York for green finance. San Francisco takes the top spot, and Los Angeles is in the top 10 as well. And it's interesting to note that in Western Europe, in terms of Western European centres, it is kind of smaller specialist centres that tend to do well in green finance at present. So places like Stockholm, Zurich, Luxembourg, Oslo, that might not feature in the top 10 globally for general financial services, but in green finance are very much seen to be leaders. And I've mentioned obviously the Asia Pacific centres in the top 20, Sydney, Beijing, Seoul, and coming up over time to put pressure, I think, on Western Europe and the US. I mentioned that we track 2 different dimensions in the GGFI survey. One is depth, and the other is the quality of green finance. So first of all, how much green finance is taking place in a centre, and secondly, what the quality of that advice is. We track those ratings separately, and so you'll see from this chart that while London and Amsterdam come top in both of those measures, on the quality side, Zurich takes 3rd place as opposed to San Francisco on depth. And so we can look to how financial centres are performing across these range of measures. You'll see, for example, that Sydney comes up to 4th place when you look at the quality rating, and it just shows that you can make a real difference in a financial centre by not only having a great depth of green finance, but also doing the green finance that you do very, very well. And we can look at the relationship between depth and quality in financial centres. You'll see from this that many centres are very close to the trend line, so they have pretty balanced quality and depth. That includes London and Amsterdam at the top. However, some centres are really out on one side or the other. For example, Osaka scores pretty much stronger for green finance depth than it does for quality. Bahrain scores higher for quality than depth. And again, for a financial centre, this is an indication of where it might want to put its effort and development moving forward. We also produce the index by instrumental factor group. So this is taking just the data measures which look at sustainability or business or human capital or infrastructure and running the index to produce these sub-indices. You'll see that London again is top across all of these, but interestingly, certain centres have particular strengths. You'll see that Seoul comes very high for infrastructure, and other centres have a balance of strengths. New York comes third on these measures for both sustainability and infrastructure. And so you'll see that again, if in financial centers, if you're looking to where your strengths and your relative weaknesses lie, this kind of analysis can be very helpful. And so if I were Seoul, I'd be patting myself on the back for my infrastructure score, and I'd be thinking of how I could move up in terms of my business environment and sustainability measures. We then can also run the index separately by industry sectors. So we take the people who respond to the GGFI survey who are working in policy, banking, investment, trading, or the knowledge sectors, and look at the correlation between their assessments and the data points in the instrumental factors. And on this measure, we see that Beijing actually comes out on top on banking and trading, with London on policy, knowledge, and investment. Shanghai does very well in banking as well. Shanghai is fourth in investment. So again, it's a different way of cutting the data, and it shows where people in different parts of the financial service industry rate different financial centers. And you'll see that some centers that in the overall index are pretty well down do particularly well in some areas, such as Nur Sultan in trading, coming right up into the top 20. And just looking at leading centres over time to get an idea of trends, as I mentioned, London and Amsterdam have improved their rating in the latest edition. Other centres, New York coming up quite strongly, San Francisco and Stockholm more stable in terms of their rating. And I think that the rise of New York is significant in this edition of the index. I'm going to go through some of the regional headlines that we see coming out of the results. First of all, as I mentioned, Western European centres still very strong in the top 10, so 7 centres in the top 10 and 10 centres in the top 20. And while they dropped back a little bit in some of the rankings, generally their rating, apart from Geneva and Helsinki, has been moving positively. In Asia Pacific, again, ratings moving positively for the leading centres in the Asia Pacific region, and really looking to challenge Western European and US dominance. It's very good to see some centres moving up pretty firmly. So we do see Wellington, Sydney, Shenzhen, Busan, Guangzhou all moving up 6 or 7 places in the index rankings. And that shows, I think, the intense competition there is in Asia Pacific and from Asia Pacific towards the rest of the world. Looking at North America, we've mentioned obviously San Francisco and New York, but quite a number of US and Canadian centres are featured in the index. Generally, however, they fell back a bit in GGFI 9. Other than the leading centres here, you'll see that there was falls in both the rankings and ratings in North American centres, and that may be a slight correction from the last edition where North America did well. In Eastern Europe and Central Asia, Nur Sultan comes out as the very clear leader, many points ahead in terms of its green finance offering from the other centres who are ranked from 70th to 79th. And certainly in the commentaries that we receive through the GGFI survey, the Astana Green Finance Centre, the AFC Green Finance Centre, repeatedly gets credited with doing very good work on skills development and green finance development in Nur Sultan, which is interesting to see. In Latin America and the Caribbean, Mexico City has moved up into the leading place in the region, with Sao Paulo second. Santiago enters the index for the first time, and I know that Michael will have more to say about Chile later on in the presentation. In the Middle East and Africa, Abu Dhabi has performed very well in this edition and has overtaken Dubai to take the leading place in the region. Casablanca remains clearly the leading green finance centre in Africa, and continues to do well. But again, overall, quite a few centres, most centres in the region have fallen back in the ratings, even if they've had some improvement in ranking. So some conclusions, I guess. Green finance continues to grow in popularity. Ratings of green finance are rising. Policy matters. Where a city is showing leadership on clean water, clean air, public transport, and livability, green finance tends to do well. And there's no room for complacency. I think the Asia Pacific challenge to US and Western European centres is real, and we'll be watching that space very carefully as we go forward. And with that, I'd like to hand over to Michael for his commentary on some of the other index results.
Well, thank you very much, Mike. Folks, if you found that a quick canter, it is because there's a lot of data there, and I would seriously encourage you to have a good look at the report itself. I'd like to draw out a few things, and I can see already from the Q&A facility here that we've got quite a few people where I hope that some of the things I'm just about to say will answer a couple of the questions there. Next slide. Now, what the team have done is to delve into things. We're always interested in trying to improve the index, and that requires a lot of criticism, self-criticism in our case, and hopefully criticism and insights from you. What this slide shows is the leading financial centers and their relationship to general financial center competitiveness. So if you look here and take New York in the Green Finance Index, it's 5, it's 4th for depth and 6th for quality. Got it? It's also number 1 in financial center competitiveness. So the relationship between New York in the Green Index and the financial center GFCI is very tight. And in fact, if you do delve into the report itself, you'll find that the R-squared, the correlation between GFCI and GGFI is actually quite tight. In fact, it's the highest. And this, we believe, is a really good indicator that green finance might be starting to mainstream, but we do have a few problems here as well. Now, as you look down this list, what we've tried to do is highlight when the financial center competitiveness is high, but the green finance competitiveness is low. So if you just slip down 2 on this, you'll see Hong Kong, which languishes at 39, 41, 37 in green, and yet in financial center competitiveness is number 3 globally. Shanghai, not so bad. And as you look further down, you'll see some centers such as Chicago, Frankfurt, Dubai, and Madrid really not living up to their position in the financial center competitiveness in terms of green. Next slide, Mike. So what you can see in this coming slide is the views of those working in green finance. And this was what we took a cut of those people who indicated in the various surveys that their primary area of emphasis was green finance. So one might argue that these people are more expert at the evaluation, and that some of the evaluations of a greenness of a center by other financial professionals may not be quite as insightful. Now here we can see going down on the Green Finance Index, so that's London at the first, Amsterdam at second, etc. We see how they're running there in terms of things, and we then look at the difference between the rank there is on, on green, and then we look at their rank in the GGFI, and we look at the difference here. So Singapore, for example, has a very large difference of 12, Boston of 16. Micah, you seem to have lost your slide set there. Boston of 16, and if we could just bring back that slide, it'd be helpful. Boston 16, we then have Stockholm, for example, at a -10. So what this means is that Singapore, amongst professionals, is seen to be doing very, very well in GGF9 in green, so amongst professionals in green, but that's not appreciated by the wider financial community. If we look further down there, for example, at Stockholm, it is perceived by many people who are not experts in green finance as more green than those in green finance, equally with Oslo and Los Angeles. Now, from our personal interactions with the various centers, this does appear to make quite a bit of sense, in particular Singapore, which has made great strides, but over a short period of time. And so this may be the lag factor where those in the green finance space see the way that Singapore is going, the direction and its achievements, but it's not been appreciated in the wider area. Mike, next slide. What we also look at every time is what is on practitioners' minds. What are the areas of interest for them? And this is very similar in one regard to previous editions. They're most interested in green bonds. Green bonds dominate the entire product area, actually, and have for a while. They're very interested in the analytics, and there's been tremendous pressure by governments, regulators, and listing agencies to focus on that. And they're interested in sustainable infrastructure finance. However, compared with previous editions, this slide is vastly more balanced. In the past, those three highlighted areas of green bonds, ESG, and sustainable infrastructure were almost spiky points. That's all that people were really interested in. So we're seeing a broadening out in the green finance space, arguably starting to match up to what we see in normal finance. And I think this is a theme that the sector is clearly maturing and showing measurable metrics indicating that. Next slide is what we're going to look at also on practitioners' minds is what do they think drives green finance? Here, again, it's quite similar to what we've seen in the past. Policy and regulatory frameworks, academic research, and risk management frameworks are pushing them. But that is a bit of a change, actually. Public awareness used to be the highest, still very high at 5.9, but 7.1 is policy and regulatory framework. So the mood amongst people in green finance and finance generally is that we're going in this direction due to policy and regulatory frameworks and don't have to wait simply for public opinion or trying to cater to public opinion or doing this purely for sort of consumer demand and marketing. Again, another sign of maturity, although this particular spider diagram is quite spiky, which indicates it's not as balanced as it might be as we look forward to future editions. Now, we indicated a particular supplement, and I hope I saw in the audience a comment from Andrew Ross about China ranked as 14, but is it the second largest issuer of green bonds? The reason for that, hopefully we'll come on to that. But Henry Tillman points out that Chile has been the first country in the world to issue a sovereign sustainability-linked bond in March 2022. And where are they ranked? Well, Henry, I think your question preceded Mike, so thank you. And as Mike indicated, Chile has entered Santiago has entered our index very, very strongly. And we've put in a significant supplement into the report covering policy performance bonds and Chile's great move. Has Chile truly raised the bar? So a little bit of background on policy performance bonds for those who aren't aware. It was in fact a concept developed in 2005 by Zien. It was created really to look at an alternative to the corporate bond market that would pull together the sovereign bond market. The sovereign bond market, with arguably 60 to 70 issuers, is actually globally about the same size as the corporate bond market internationally of about 10,000. So you've got two large pools of capital, and we really wanted to pull those together. This is all part of, many of you will remember, the huge London Accord burst in 2005, 6, and 7, resulting in this enormous 780-page report published at Mansion House at the end of 2007. The London Accord continues very much as a facility for people in investment research to donate any research that they've done of a long-term or thematic nature so that people can actually access that. And it contains about 700 reports online at Zien, all available to those who would like to see the longer-term thinking of the city. Now, this idea was really quite a simple one. It arose out of why wasn't there something like an inflation-linked bond? To remind many of you, the first inflation-linked bond was actually issued in 1780 by the Commonwealth of Massachusetts and contained a number of a basket of goods, which I think included things like beaver pelts. Anyway, the idea behind an inflation-linked bond is that the government has set a policy. Inflation will be kept to X, whatever X is, but let's say 2%, which is fairly conventional these days. And if the government fails to achieve its policy, it pays a higher interest rate to bondholders. And again, typically in an inflation-linked bond, if the target was 2% and inflation was 5%, the difference, 3%, is what would be paid to bondholders. If inflation goes up further to 10%, then 8% would be paid to bondholders, and so on. If the government, on the other hand, succeeds in keeping inflation at 2% or less, then effectively it gets a loan with no interest. So that's the concept behind it. And the bondholders really don't care how the government achieves its inflation reduction goals. It cares that it achieves them at all, and that's it. So you could issue a slightly different bond and perhaps call it an inflation-linked bond, which says we wish to raise these billions and we're going to put it into these places to reduce inflation. But if it doesn't reduce inflation, tough. And that would be what you'd call a use of proceeds bond. Now, green bonds so far have virtually been all use of proceeds bonds, so we wanted to focus on the outcomes. So issued with some sustainability performance targets, then you can do a whole bunch of other things. Now, policy performance bonds do not need to be just green. They can be in any policy area. So I would argue an inflation-linked bond is a policy bond, but there are ones, for example, in Malaysia, a 10% reduction in 16 to 20-year-olds not in employment, education, or training by 2030 has actually been issued by a state in Malaysia. So this whole idea of the targeting is open to whatever you'd like. And as the text says here, sort of a step-up clause means the bond rate increases. And it doesn't have to do so linearly in the way I did with inflation-linked, although simplicity is a virtue. Now, this idea was not particularly well received in London back in 2005 to really about 2015, but the French government became enormous supporters of this, and two of us, Jalil Bouzidi and I, wrote a piece for the Prime Minister's blog in France in 2015 and presented the idea at COP, and the government sponsored this booklet on financial innovation in service of the climate. Which was published in 2017. And we saw a huge number of issuers in the corporate sector, starting with the likes of Louis Vuitton and Danone and Enel. So this has been moving on the continent. And in 2020, the market on the corporate side wasn't particularly huge, but it was 11 billion, which was not totally insignificant. But it rocketed last year. And in 2021, the issues of these linked bonds or performance bonds was over 110 billion. So very much rocketing up. But the original idea was targeted more at the sovereigns than it was at the corporates. The corporates were doing this because it's harder, it's firmer. The lenders like this kind of simplicity and directness, and so it scored there. But we were missing the sovereign market. And then, next slide, the Republic of Chile, who had been working with Jalil, launched last month the first ever sustainability linked bond. Now this bond is fascinating in the fact that it's almost ideal. It's a 2 billion 20-year sustainability linked bond, sovereign. There are 230 investors have piled in, and it's more than 4 times oversubscribed. The idea is, as it says here, to embed the green in financial incentives. Now, it's intriguing as well to see what Chile chose as their key performance indicators for those step-up clauses, and there were 2. The first was a reduction in greenhouse emissions from 112 million tons per annum in 2018 down to 95 million tons per annum by 2030. So a reduction over 10% from current levels, slightly less than 20. And the other one was an increase in renewable energy generation. Renewable energy generation in Chile is running at around the 45% level, and they intend to get it up to 60% from renewables by 2032. So these are some pretty good targets. What makes a bond like this particularly exciting for investors is, of course, the ability to use these bonds to hedge the policy risk that you might see in a government. So if you are an investor in a Chilean wind farm and you think the Chileans are never going to meet these targets without using wind, but on the other hand, you do wonder about government's commitment to the targets, you can buy this bond as a hedge. and therefore your hedge is not opening or investing in fossil fuels. So this drives huge amounts of capital, or hopefully will drive huge amounts of capital into sensible green investments, knowing the government policy is much firmer. For those of you who are familiar with the political risk arena, this is actually a political risk bond, or a political risk sanity bond. So we're very excited about this, and please have done it. I would encourage you to read the supplement, which contains quite a bit of detail and quite a bit of input from the government of Chile and Santiago and the debt issuance office there, who've been very, very helpful. At the same time, of course, next slide, Mike, guess what? This does drive us exactly where we'd like, which is Santiago has entered the index quite firmly, and we hope that it rises given this sort of innovation being seen by a sovereign. So, Mike, welcome back. Folks, we now turn to, we've got about just under 15 minutes for Q&A. But let's pick up on some of the questions, and please do type questions in to the GoTo facility. Mike, Andrew Ross, I'd like to expand a little bit. China's ranked as 14, but it's the second largest issue of green bonds. Any thoughts on why that's the case? Why I presume Andrew's really saying here, why isn't it higher?
Yeah, so it's true. China is second largest issuer of green bonds, and some of those green bonds, of course, are issued through other markets. But even so, the thing that drives performance in our index is balancing both depth and quality. At the moment, in terms of the quality measure, Western European centres in particular seem to have a premium. And China at the moment is not matching that in terms of the quality of its green finance, particularly in the human capital area. I know that's changing, and I was on a call with the International Institute of Green Finance in Beijing just a couple of weeks ago, talking about how they're developing their measures of green finance and looking to improve. But at the moment, I think it is the quality side that is meaning that China and other Asian centres actually still have a little way to go to match the performance of Western Europe. I think it is coming, and I think, as I've said in my presentation, the challenge from Asia Pacific is very real in terms of the leading centres in this index.
Now, quite an insightful question here from Hugh Purser. Is it possible, Mike, for you to comment on the depth of the market in green finance, so the depth compared to other areas of finance? In fact, is depth of the market the main driver of future success and adoption of green finance?
I think and the answer is, I think the depth of the market in green finance has grown very quickly. And this is a result partly of government action in terms of regulation around disclosure and other matters. It's partly the commitments by investors to move away from financing fossil fuels. And so more and more of the funds under management across the world are in funds which are looking to invest sustainably. And so the depth of the entire market certainly has grown very quickly over recent years. And the depth of the market, I think, is certainly something which is driving the adoption of green finance in financial centres. If the money being invested is looking for investments which are sustainable and looking to move out of fossil fuel investment, then it means that financial centres and the businesses operating in them will respond to that market pressure, will respond to the fact that people are looking to invest in sustainability. So I think it's the depth of the market is certainly driving financial institutions to create instruments and opportunities which are properly green. But this is a symbiotic thing. I think the governments are regulating, financial institutions are shifting as regulators move towards green, and our financial market is both responding to and driving that change.
Mike, on the slide that where I was pointing out what's on practitioners' minds, and that there's been that quite significant shift in the 9th edition from it being public awareness as being the highest and most important bit to it being policy and regulatory frameworks. Might you like to speculate on when we don't need a green finance index because green finance is mainstream?
Well, I think as we've said, there are some signs in this edition of the index that mainstreaming is starting to happen. The correlation between the Global Financial Centers Index and the Global Green Finance Index is starting to shift closer together. And over time, if that continues, we can all stop talking about green finance and just talk about finance, because finance will have greened itself. But I think we've still got a very long way to go. If you look at the challenges of the Sustainable Development Goals, the amount of finance that is required to meet the Sustainable Development Goals, and the financing gap that we know exists between the goals and the finance required to achieve them, then we can see there's an awful long way to go before the financial ambitions match the needs of the Sustainable Development Goals. So if I were a betting man, I'd probably say I wouldn't put my money on full mainstreaming for another 20 years, but it is moving in the right direction, and I think we can see that from the data we're starting to see come through the GGFI.
Yeah, I feel a bit like you. It's a 20-year thing, and I guess given that governments seem to have coalesced around net zero 2050. One would hope that it's definitely gone by 2050. But yeah, it's probably along those timescales, despite the increase here. And of course, in many ways, this sovereign sustainability linked bond from Chile is an interesting example. So clearly there will be a green financial instrument in Chile out until 2032. Oh, sorry, what am I saying? For another 20 years. Sorry, yes, it's 2032 targets, but out further. I got an interesting observation here from Andrew Ross. Mike, we've had the task force on climate-related financial disclosures, and certainly that has got a lot of attention, and it's generated tremendous amounts of paperwork. Not 100% sure of the results, but we're now moving into the task force on nature-related financial disclosures, which of course includes that huge area, complex area, and one that is frequently missed by those of us who spend too much time in climate, because climate is in many ways a simple one. So this task force on nature-related financial disclosures following hot on the heels. But if this is the case, then why is it that practitioners don't seem to rate biodiversity so highly as a topic?
Yeah, it's been a consistent finding throughout all the editions of the GGFI that sort of biodiversity and natural capital valuation have come very low in terms of the rating of what is most interesting in green finance. We did a piece of work on biodiversity as a supplement to another edition of the GGFI. From memory, that was GGFI 5, but I don't have it with me today. And one of the things that I think is driving this is there's not an easy set of financial instruments which the market can engage with that address towards biodiversity. So we know that governments do take action to protect wildlife spaces, to protect natural capital in various ways. But as yet, we haven't seen financial instruments developed which are designed to invest in biodiversity, invest in protection of particular habitats. Not to any great extent. There are a few. There are some blue bonds, for example, on marine habitat, which are available. But on the whole, I think it's because there isn't anywhere to go in terms of investment opportunity, and no one has yet managed to find a way to provide a return on biodiversity investment in quite the same way as we have done with green bonds and now sustainability-linked bonds. Michael, you might have some other thoughts on that one, but that's how I see it at the moment.
Well, no, I agree. That I also know that Andrew is quite a proponent of blue bonds as well, as am I. But you're right, there's a dearth there. A lot of the dearth, I think, has to do with measurement. Many of the things that seem so simple on paper, sitting in an office, we'll just measure all this by satellite, turn out to be much more complex. And even the biologists disagree on many of the subjects of what is a biodiversity index, how is it calculated, how is it put together. So yes, it's going to be a very, very tough area. I think then we move into the middle. We have a whole bunch of set-aside type work in marine conservation or in forestry. Probably interesting, although some recent reports in Nature just this month have indicated that maybe those aren't quite as effective as people like me who like to think, and that we also need to do a lot more work on corridors linking these biodiversity areas together, that some of the habitats are actually too small to support what you want to achieve isolated on their own. So a lot of work there I think needs to be done, and I think it's going to be slow, hard work, which is a bit depressing when you think how slow and hard it's been to do something as simple as getting people to stop polluting, i.e. carbon. So some tough stuff there. Now, Clive Bullen has a question here for us, Mike. What advice would you give us as individuals to help improve green finance?
Oh, it's a very broad question, so I'll do my best. I think the first thing is to be talking about it. That if you're thinking about any sort of financial service, financial instrument, advice from advisors, professional, whatever it is you're involved in, make sure it is part of the agenda. Some companies are now, for example, ensuring that their head of sustainability strategy is on the board, which makes a real difference in terms of how people move. When talking to potential clients, talk up the fact that you have some green finance expertise, talk up the fact that green finance is the way to go, talk up the fact that green finance can make serious money for people. Be alert to the opportunities. So it really is. It's about having it front and center in your mind, in your people's minds, that green is an option whenever you're talking about any kind of financial instrument or any kind of advice that you're offering, wherever that conversation is taking place. And I think that's it. It's having it front and center in your mind and making sure it is part of the conversation whenever business is being talked about. Michael, what would your tip be for individuals?
Well, I think ultimately what we're seeing is this idea that the political and regulatory frameworks, and I believe that most of it is not about awareness. Personally, I think everybody is pretty aware. I believe that the biggest issue is looking at getting the regulatory frameworks to bite. But do be aware, and I've put into the chat room some of my thoughts that you can see on a presentation I did as to why I was not at COP26 in Glasgow. That real finance beyond ESG has real costs, and the cost estimates in the London Accord that I referred to earlier, in the Stern Review, and even if you just take the current carbon price, are all that it will cost about 500 to 1,000 euros per person per year for 28 years. And you heard it here, and you shouldn't have heard it here first, because if you've been in this debate for the last 20 years or more, those have been the costs fairly steady. And I think we've got to start addressing that. It's not going to come by labeling existing corporate work green. And I also think there's some problems too with some of the things in the ESG sector that we again don't recognize, as we're driving people off of the capital markets and into private equity. So long as you have a legal business, even if it's brown, if you've got a legal business, it's generating cash flow, it has value. And you're denying some of that value, therefore, to pensioners and all, and you've got to look at the deeper moral decision in that if you're not pushing it. So my big push would be push your politicians to really put a price on carbon if it's climate that's your principal driver, and get them to issue some of these sovereign sustainability linked bonds, which proves that the government actually means what it says. Anyhow, we've come to the end of time, and I just have a few quick rounds of thanks, if I may. Firstly, to our sponsors, as ever, very, very generous and kind in letting us really go out on this kind of research, which otherwise we couldn't afford to do. Secondly, I'd like to thank the audience. We have a number of events coming up. I'd just like to pick out a couple, if I may. The one on Can a Standard for Good Governments Make a Difference is going to be looking at something I believe most of our community is excited about, and it's going to be looking at, would something like ISO 37000 actually make a difference? We're going to have another session on cryptocurrencies week after next. We're also looking at a spring party for those of you based in London. There's a spring party coming up. Please go and register on the site if you'd like that. For those of you in Jersey, we have a physical event, the Employee Share Schemes and Trustees Conference, 2022 at the Palme d'Or in St. Helier is there. And for those of you on this particular webinar, on the 18th of May, there's a free conference in the afternoon at Birkbeck College, uniting the city with Birkbeck and their environmental work. So lots coming ahead as ever. Please do check out the website. But my final round of thanks really has to go to my colleague. I do very little work these days, as Mike does all the hard graft here. And I'd like to thank you, Mike, for your contributions. And to the audience, thanks again for being online. And we look forward to your thoughts and observations as we try and move forward into helping solve some of these big global issues.
Thank you very much, Michael. Bye-bye.